Hi, this is Dawn Rickabaugh over at Note Queen Capital Funding and Owner Financing Club. And right now what I want to talk about is how an all-cash buy and hold real estate investor can diversify through intelligent use of owner financing strategies. The reason this came up is that lately I've been visiting some real estate investment clubs, and you find most people talking about, wholesaling, buying all cash, rehabbing or not, flipping, or buying and holding kind of business models. But I'm kind of amazed at how obscure the concept of owner financing seems to be for these investors who are otherwise, quite proficient at what they're doing. And in my opinion, owner financing helps investors leverage their available cash and get below market terms and limit risk for capital losses if something doesn't go quite right in the market. So let's talk about what I mean. Here's a deal one buy and hold investor ran past me recently. She's used to putting up a lot of cash, all cash up front, to acquire and rehab properties, and then her tradition has been to use hard money to pull as much of her equity back out as possible, while still leaving a little bit of positive cash flow every month. And in some instances it works amazingly beautiful for her. For instance, she bought this one property for $40,000. She spent $5,000 rehabbing it, so her total cash in is $45,000, and she can rent it for $1,000 a month, which is wonderful. And after expenses each month, she can clear about $700 a month. So her cash on cash return just to buy and hold her free and clear rental is about 19%. And that's indefinitely, as long as rents hold up, and there's nothing unexpected, like the job market dries up in that town, or there's catastrophe, some sort of natural catastrophe. You're always having some risk when you're holding a property, right? But then you also have the upside of appreciation too, so it can be double-edged sword. So now she's taking that 19% return, and here's what happens when she gets a loan. So the appraisal came in, remember she's in it at 45, the appraisal came in at 65,000. She can get up to a 60% LTV hard money loan, so that amounts to about 39,000. The fees are pretty high, so about 4,000. So let's see, after pulling out, she'll get about 35,000 when all is said and done. She's got a very good interest rate. This is very good for hard money. It's less than 11%, and usually it's closer to 12, sometimes even more. She's got an interest-only monthly payment of $345, so $700 cash flow. Minus now her debt service of $345 leaves her with a positive cash flow every month of $355, and that just more than doubles her cash on cash return, right? It's up to 43% now, because since she's pulled out $35,000 out of the $45,000 she initially spent, now she's only got $10,000 sitting and working in the deal, right? She spent $45, she got $35 back out, and now she's still getting $355 a month. And so that's phenomenal, and that all works great, except for this is just 3-year financing. So what's going to happen 3 years from now when they call the loan? Is she going to be able to replace it with as good a financing, or will properties have dropped and they just want their money and she'll have to sell, or what? So there is she could have some trouble down the road if things didn't go so well, or the cost of private financing got a lot more expensive. Okay, this is not bad, right? Even with the high costs, that $4,000 it cost her to get the private money, she still more than doubled her cash on cash return by getting the loan. And this is all good unless rents go down or financing costs go up, like we were just saying. Now let's look at a different exit strategy just for kicks, to give flexibility and mitigate risk and just diversify. So if one thing doesn't end up working so well, then maybe another angle will basically hedge your position. Instead of buying and holding for rental cash flow and future appreciation, let's see what happens when she sells or flips on terms, owner financing, to another investor for passive note income instead of passive rental income. Okay. Investor number one gets her down payment of $26,000. Right afterwards, after she creates it, maybe in a double sort of escrow, I buy that $39,000 note for $30,000. So yes, she's taking a $9,000 discount. Let's see what happens to that. And that's like, oh, she's walking away from so much of her cash. So at close, she gets $56,000 for her $45,000 investment. That doesn't seem like very much, right? $11,000 in profit for all of that. Well, remember, that's a 24% increase in just 4 months. So if she does that 3 times a year, right? If she, every 4 months, she does this exact same thing or even does it better, that's an annualized cash-on-cash return of 73%. Now that's the biggest number we've seen so far, better than any other strategy. So we can see that selling to an investor on owner terms and even immediately selling the note created for a discount, she can still take this strategy and more than double, almost double of any of the other strategies that we've talked about so far. So that's pretty incredible, and I don't think most people understand that.